1. Start with energy, explain with authority, highlight with emphasis, end with warmth. Opendoor Technologies Inc. is currently trading at exactly $6.48, down approximately $0.21 or 3.14% on this trading session as of 1:21 p.m. Eastern Time on Thursday, November 20th. The intraday chart is painting a picture of exhaustion, a classic hangover pattern following the erratic, almost euphoric volatility we witnessed earlier in the week. After opening near $6.96, the stock faced an immediate wall of selling pressure, failing to hold the $7 psychological support level and drifting lower in a jagged stair-step fashion. We are currently seeing a consolidation phase near the day's lows, with the price action pinned between the 640 and 650 range, struggling to find a bid in a market that is suddenly asking tough questions about the durability of the recent rally. The immediate expectation from the retail gallery, seeing this 3% drop, is that the meme stock momentum has simply paused, that this is a healthy pullback for the next leg up to double digits. They look at the recent headlines about Opendoor 2.0 and the aggressive moves by management to burn the short sellers, and they see a company fighting back. That is the expectation, a temporary breather in a heroic turnaround story. The reality, however, is far more cynical and mathematically brutal. What we are witnessing today is the market sobering up to the financial engineering that sparked the recent run. The distribution of tradable warrants, a move designed specifically to cause a logistical nightmare for short sellers, created a mechanical squeeze, but it did not fix the underlying broken engine of the business. You are looking at a stock that is trading on structural gimmicks right now, not on the fundamental reality of selling houses for a profit. Today's drop is the smart money fading the gimmick. Common belief suggests that Opendoor is a technology company, a peer to Tesla stock or Nvidia stock, that just happens to transact in real estate. Investors see the Silicon Valley pedigree, the backing of major venture capital names, and the slick app interface, and they assume the valuation should reflect a high-margin software business. I want to challenge that perspective immediately. This is not a software company. This is a capital-intensive, low-margin, asset-heavy flipper of residential homes that is currently masquerading as an AI play. The market is punishing the stock today because the AI pivot narrative, the idea that algorithms can replace human inspectors and pricing agents, is hitting the hard wall of reality. You cannot software update a leaking roof or algorithm away a foundational crack. The friction of the physical world is undefeated, and Opendoor is paying the price for trying to ignore it. Let's break down the intraday volume because it is highly instructive. We are tracking towards 65 million shares traded, which is robust but significantly lower than the explosion of volume we saw during the warrant announcement. This declining volume on a down day is often misinterpreted as bullish, i.e., sellers are running out. However, in this context, it suggests that the greater fool theory is running out of steam. The aggressive buyers who were chasing the squeeze are trapped above $7, and the institutional capital is stepping aside, letting the price drift until it finds a valuation that makes sense based on book value, not hype. The order book shows a distinct lack of depth on the bid side, meaning that if we break $6.35, the flush could be rapid and violent. While the Reddit forums are busy discussing gamma ramps and short interest, we need to look at the actual mechanics of the business that were revealed in the Q3 2025 earnings. The company beat revenue expectations, bringing in over $900 million. That sounds impressive until you look at the gross margin. It is sitting at a razor-thin 7.2%. To put that in perspective, a traditional grocery store, often cited as the worst business model for margins, often has better unit economics than this. When you factor in the holding costs, the interest on the debt used to buy the homes, and the selling expenses, the contribution margin is barely positive. This means for every dollar of revenue they generate, they are keeping pennies, if anything at all. The market is selling today because they realize that scaling this business up doesn't necessarily lead to profits. It might just lead to bigger losses. Let's discuss the warrant dividend strategy, because this is the single most important tactical event in the stock's recent history. Management decided to issue warrants to shareholders, effectively giving them the right to buy more stock at higher prices in the future. Why? Because it forces short sellers to go into the market and borrow these warrants to pay the dividend to the lender of the shares. It creates chaos in the securities lending market. It was a brilliant move to punish the bears, similar to tactics we've seen in the crypto world or with GameStop. But here's the catch. Financial engineering is not a business model. It is a sugar rush. Once the shorts have covered or adjusted their positions, the stock price has to stand on its own two legs. Today, we are seeing the sugar crash. The shorts are arguably smarter than the retail crowd gives them credit for. They have recalculated their risk and are likely re-entering their positions at these elevated levels, betting that the fundamental burn rate will ultimately drag the stock back down. Now, I want to pause and ask you for your input, because this is a highly contentious stock. Comment below with your honest opinion. Is Opendoor's AI pivot a genuine innovation that will save the company, or is it a desperate buzzword marketing ploy to distract from the balance sheet? Do you trust the algorithm to price your home, or do you still want a human agent? Let me know in the comments. Moving back to the analysis, let's look at the macro environment for housing. The narrative has been that lower rates will save Opendoor. The Federal Reserve has signaled cuts, and rates have come down slightly from their peaks. But this has created a paradox. Lower rates bring more inventory to the market as sellers finally feel comfortable moving. The lock-in effect thaws. For Opendoor, more inventory is a double-edged sword. Yes, they can buy more homes, but so can everyone else. The competition heats up. Moreover, if inventory floods the market too fast, home prices soften. Opendoor is essentially a massive inventory hold. They own thousands of homes. If the value of those homes drops by even 1% while they are holding them, it wipes out their entire profit margin. They are structurally long the housing market with massive leverage. If housing prices stagnate or drop, they are underwater. This sensitivity to home price appreciation is what makes the stock so volatile. It is a levered bet on the Case-Shiller Index. We also need to talk about the Opendoor 2.0 initiative. The new CEO, coming from Shopify, is trying to turn the company into a platform. They want to automate everything. They have fired a huge chunk of their human workforce, the people who used to manually review home inspections and pricing models, and replaced them with AI agents. This sounds fantastic in a slide deck. It reduces overhead. It makes the company look like a tech firm. But real estate is a high-touch industry. When an AI misses a termite infestation or overestimates the value of a renovated kitchen because it misread a photo, the company loses $50,000 on a single transaction. The market is skeptical that you can fully automate the messy, subjective process of valuing a unique piece of property. We saw Zillow try this with their offers program. They had the best data in the world, and they failed spectacularly because the algorithm couldn't predict the local nuances of the market. Opendoor is betting the entire company that their AI is better than Zillow's was before. That is a massive gamble. Let's compare the user experience for the investor trying to play this trend. If you are using Robinhood stock trading or the SoFi trading platform, you are likely seeing Opendoor pop up on your daily movers list constantly. It attracts the gambler. It feels like a lottery ticket. But if you compare it to a Fidelity wealth management approach, you see the stark difference. A prudent portfolio might hold Home Depot or Lowe's to play the housing market, companies with cash flow and dividends. Opendoor is the antithesis of safety. It is similar to investing in a biotech company that has one drug in trials. If it works, you get rich. If it fails, it goes to zero. The drug here is the automated market-making model for homes. Technically, the stock is trapped in a massive downtrend on the weekly chart, despite the recent rally. The 200-day moving average is still looming overhead as a major resistance level. The stock is currently dancing around the 50-day moving average, trying to use it as a springboard. The Relative Strength Index, RSI, on the daily chart hit overbought levels last week during the warrant squeeze and is now cooling off. This cool-off is what we are seeing today. The danger zone is below $6. If it falls below $6, it re-enters the penny stock liquidity trap, where